And guys, I had a really embarrassing moment last week, which I don't even know if I'm personally ready to share and open up about, but let me tell you basically what happened. So there's me getting a little bit carried away, and I've written a series of letters to people from my past for the future. And then I CC'd myself into these letters, so I get a copy of them, and this is exactly what happened.
And the future has come, lo and behold, the future is here today.
Hi guys, thank you so much for joining me in another video. Today I want to talk about the 3 biggest mistakes investors can make. I know I've had a little bit of a rant recently about those retail day traders that don't really have much experience in the market but think that they have it all figured out with some random system. You won't be figuring all these things out sitting at home in your spare time when there are markets out there that are running 24/7. Anyway, if you are interested in all that jazz, I have got a video up here which I'll link about the craziness of day trading and even about whether Warren Buffett has lost his touch. Generally, I'd always recommend reading, research and testing strategies before you commit to the market. There's lots of platforms out there that will allow you to run test strategies and theories before you actually invest real money. I do get quite annoyed and angry with all the marketing that tries to change that retail investor into thinking that there's some hotshot trader. Tragedy is, in this case, is these people lose the opportunity to build their wealth over a lifetime because they invest and they take risks on these short-term trades. But don't get me wrong, there are day traders out there, and especially there are some YouTubers that are really good at it, but that is because they have the discipline to keep going and also to know where there is where their boundaries are. So in this video I want to cover the 3 biggest mistakes retail investors make and how we can stop being our worst enemy. So let's just jump straight into this one. Cute intro. The first biggest mistake that retail investors make is thinking that you can beat the market. Hold your horses and let me explain this notion a little bit. Some people tend to think that they can beat the market through some jiggery pokery, some magic, some clever tricks, and maybe you do have those clever tricks, but you can do all of these things and you might beat the market. And the thinking behind that is that you can beat the fund managers, you can pick better stocks and you get better returns from the stock market. But the reality is,
that's not true, guys.
If you have figured that out, then I'm sure everyone in the community wants to know. So leave a comment down below and let us know. Do you remember that time when Kim Kardashian played poker with reflective sunglasses on? Enough said. So don't be that person that thinks they got all the money, can take all the risks, and will be amazing at something they have no clue about. So how do you counter this? While you're invested, have tracking strategies. Don't fuel the urge of having to be involved in the market just because you've got spare time. Don't overtrade. Instead, think about your investment horizon and think about the long-term gains that you'll get over investing over a longer period of time. Those market tracking investments will deliver you so much more benefit in the long term. Once you realize that you will not trade and track the market, it will automatically have an effect on how you trade. You won't be losing money on making those trades in the first place, and that urge that you might have at your fingertips will actually go away. Those of you that have been following my channel, those of you that have been following me from the beginning know that finance isn't my background in terms of education. My background is engineering and technology, and that's why I like doing these checklist videos, because I've researched a broad range of topics without having any bias. And so that's why the second mistake I think that investors tend to make is taking too micro a view on what the investments are. In order for us to get a sense of how the professionals view the world, we have to take a step back, almost fly to the sky and look down. And in engineering terms, it's called a top-down approach. So as a normal individual, we have a home country. So whether that's in the US or the UK or the EU somewhere, I'll run through my situation. So you have a home country, and that's the UK for me. And within that, you live in a city, which is London. You grow up in that city. So I've grown up in London my whole life. I've got a career in London. I studied in London, and well, I also studied a little bit abroad, but that's a story for another day. My career going forward and for the rest of my life will probably be in London because I have no plans to move anywhere just yet. So based on that, all my investments, they are also in London. So the houses that I've bought, they're in London. And therefore the risk is really concentrated in one place. So both wittingly and also unwittingly, we leave all of our capital concentrated in one place. Subsequently, our capital becomes a function of our domestic economy. Now, do you realise what I'm trying to say when it comes to that concentrated risk? And then as a Brit, compared to our US and EU neighbours, we've probably done a lot worse when it comes to our economy over the past few years because of things like Brexit. And therefore, the growth of our economy has been dampened. And that in technical terms is known as home bias. And what that essentially means is that we're setting ourselves up for everything that can possibly go wrong to go wrong all at once. Now in the YouTube community, the diversification is really impressive. And almost you have access to all these markets at your fingertips because of the technology that we have at the moment. And given the influx of all these e-brokerage accounts, it not only gets easier, but it allows you to trade in your downtime. Well, those few hours that you have during the chocolate break in the afternoon. I don't know about you guys, but I remember when I was at work, about 3 o'clock, we'd say is the lull hour, because that's when you need a chocolate bar or a coffee hit or some kind of sugar to keep you going for the next couple of hours towards the end of the day. I don't know, I feel a little bit nostalgic about work at the moment because I'm going back to work in a few months when my maternity ends. The final thing I want to talk about home bias is the fact that your biggest investment, which is your home, will be the thing that is affected the most, right? So for example, typical mortgage rates have loan to value ratios of about 80-20, where 20% is the down payment that you might put on your house. If, for example, you have an LTV of about 80% and the property prices drop by about 20%, then all of a sudden you've lost an entire 20% of the equity investment that you've put up front into your property. And going even further, if you do decide to sell, then you have to find that money from somewhere, and that might just mean that you're borrowing again and you're borrowing more to cover those losses. In London, the average mortgages are around 220,000, and that's just the statistics. In some areas, you're looking at 1 million. In other areas, you're looking more like 500,000, and that's just in London. But the averages come down to around 220k. And that's nothing to be sniffly about, because if you do start losing equity in that, then it is quite meaningful, especially when you want to buy again. Third and final mistake I want to talk about is not thinking long term. So I did a little bit of digging on my YouTube channel and the analytics, because YouTube were quite transparent about that. And it gave me a little breakdown of what my audience is. So you've got, say, female, male split about 50-50. But also a large chunk of my viewers are between 25 to 34 years old. That just means a large chunk of the viewers are about 20 plus years away from retirement. And so that probably means that we can all be a little bit more riskier when it comes to our asset allocation. And by that, I mean allocating a large chunk of your portfolio to something like equities. And the long-term investment horizon for equities over 20 plus years has been pretty positive. But the question is that the right approach even? There are arguments that state that's a little bit too aggressive, and it's a little bit presumptuous and arrogant thinking that that is what will happen. Well, if we just look at that example of Japan in the 70s and 80s, if you know, you know, if you don't know, just get to know. I'll try and put a link down below. And it was seen by the world as the miracle economy. Why was Japan the miracle economy? Well, the markets were booming, they were booming. But in the last 25 years, they have dropped 75%. That essentially means if you invested £100 in the Japanese economy in the 80s, right now it would only be worth £25. Ooh, that gives you goosebumps actually. So imagine being Japanese and then investing all your money in the Japanese market and buying all your investments in the Japanese market and allocating all your assets in the Japanese market. Imagine the situation that you'd be in today. The main thing I suppose here is that you have to adjust your risk according to where you are in life. So it might be that you're single and independent right now and you've got lots of money to kind of invest here and there. But in the next 5 or 10 years, you might be thinking about having a family. You might be thinking about creating a business. You might be thinking of other financial responsibilities. You might have responsibilities of caring for a family member. The point is you have to manage your risks accordingly. Now, those of you that follow me on Insta, and if you don't, here's my Insta link, follow me because I'm entertaining. No, just kidding. If you are, it's not really financy stuff on Insta, it's just my general life. And guys, I had a really embarrassing moment last week, which I don't even know if I'm personally ready to share and open up about, because I was just about 12 years ago, I used to live in Singapore. Well, exactly 12 years ago to the day, I used to live in Singapore for a few years, and I was doing research, I was living the high life, I was traveling the Far East, and I was doing all the great things that could have come with that, right? So what happened was, so I was sat there on my sofa in my condominium, and I come across this website, futureme.org, and I'm thinking, okay, great, I'll just write some letters, as if this website is going to carry on, and it probably won't even exist in the future anyway, because the website would have been shut down, and as if this is a real thing. So there's me getting a little bit carried away, and I've written a series of letters to people from my past for the future. So, and then I've CC'd myself into these letters, so I get a copy of them, and this is exactly what happened. The future has come, lo and behold, the future is here today. And so I opened my email earlier on in the week, and it said, you've got an email from the past. And then I was about to, when I said I was about to be sick, I was actually about to be sick. But, well, the moral is, don't email people in the future, especially if it's an ex or anything. Just don't do it. Because honestly, when I saw that, I just thought, I hope these people don't use those inboxes anymore. And guys, I even have a Hotmail account. Like, who uses Hotmail anymore? Why do I still use Hotmail? Now you know how old I am, right? Honestly. Anyway, by the by, what I actually wanted to say is, if you go to futureme.org, you can still write letters to yourself. So if you want to write yourself a note for the future about your financial situation, the risks that you're taking, think about what your future self will thank you for, rather than what you might regret in 10 years time, right? If you do have that FIRE mindset or are aiming for early retirement, then what you do need to keep in mind is having your assets allocated across investments that will allow you to have drawdown, and also be allocations that will be inflation beating, so that you have continuous growth over a longer period of time. And if that all sounds like jargon, then don't worry, you have 10 years to learn, right? Guys, what I find the best thing is the old school method. If I'm trying to learn something from a YouTube video, I'll always have my little notebook and my pen, and I'll take down notes of things that I actually like, and things that I want to adopt when it comes to investing and learning from YouTube videos. I don't know if that helps anybody, but at the beginning of the video, just have a little pencil beside you. It might be old-fashioned, but it works, trust me. But those are the 3 biggest mistakes that I think investors tend to make. And if you watch this video through, then you'll know what the bonus 4th mistake is as well. Finally, one more shout out, I think, to Lars Kroyer. I've mentioned him before, and his book Investing Demystified, I found as a beginner one of the best books that had clarity. It was concise, and it was just, you know, the facts when it comes to investing, and I think that will help anyone that's beginning their journey. I'll link it down below. This isn't a book review. Alright, so there you have it. I'll wrap up now. What I do want to say is, please subscribe, leave a comment, let me know what you guys think. Oh, I am a new channel, so leave a comment, subscribe, do all of that fancy jazz. But until next time, cheers, bye.